Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Big news, and I'm sure you've heard about it. India and the US have signed a trade deal. The nuances, the fine print of that will emerge over the coming weeks and days. But the good news has already been absorbed to a certain extent by equity markets, which have risen quite substantially. This is a major overhang that a lot of people have argued held equity markets and in extension your portfolios back all through 2025 and even in the start of 2026. The question is, where does this take us right now? Is the bad news behind us, and does that mean more good news for your portfolios? Let's find out. We're joined today by Trideep Bhattacharya, who is the President and CIO Equities, Edelweiss Mutual Fund. Trideep, thanks so much for taking the time. Let me first ask you, did you anticipate that it would get done as soon as it did? Or when it did happen, because we've been waiting for it for some time. The point was that we waited for so long, a lot of people believed it was not going to happen.
Thanks, Alex, for inviting me to your show. Yes, indeed, the timing of it does come as a surprise. So one of the things that I've been saying for the last couple of months is that in this year, calendar year 26, we will go from trade conflicts to deal making. And in that context, the Indo-EU deal was the first one to come along, which was fine, second only after the United States. But what took everyone in the market by surprise is the timing of the US deal. Timing is one part. The other part is basically the extent or the number of 18%, which places us amongst the lowest tariff rates amongst the trading partners of the United States. I'm sure we'll talk more. So both of these, I think, are reasons to cheer.
So we'll talk about some of those implications for Indian equity markets. But Trideep, on the point of Europe, I read an interesting headline this morning from the perspective of the US. Whatever you can do, I can do better. What do you think about that?
Well, play with the words, but I think overall, in a matter of a fortnight, we've seen close to 50% of our exports, or even more than that, covered by deals, which is a very good outcome, and from a macro perspective.
Okay, so let's talk about it from the Indian equity perspective, and specifically from the mutual fund investor perspective, right? Because let's face it, the broader markets have seen tremendous pain, and the way that a lot of people have constructed their portfolios, just the hangover from the post-COVID-19 bull run, is that the tendency is to gravitate towards the broader market funds. And as a result of which, there's been a significant underperformance of portfolio over the course of 2025 and 2026. In fact, in 2026, Trideep, the small cap index, as of yesterday, had lost more ground than the full of 2025. So does that pain abate? Does it reverse?
Directionally, yes, though I would still start with the large caps and then gradually go on to the small caps, because let's evaluate the situation. This deal, or these two deals, come on the back of the premise that India had underperformed emerging markets by close to 40% over the last year. So, and all of a sudden, in a matter of a fortnight, the major macro headwinds, which was on currency and the fact that we were not the favorites of the United States, or for that matter, globally, has changed. So the view of the constituent of the market which changes the most in this is FIIs. So from an FII market, on the back of a strong underperformance, when such a trigger or catalyst happens, usually the first favorite is the place where the FIIs goes, which is typically the large caps and the larger mid caps. And that would be followed by the small caps over a period of time. So on net balance, what I'm saying is these two deals first will turn around the sentiment in FIIs, and that should mean a bit more buoyancies in large cap first, and then go percolating down to mid and small caps.
So what you're saying, Trideep, is that the up move from this point, and of course today you've seen a justified, not knee-jerk reaction. This is justified, if anything, right? But you're saying that the up move from this point is going to be predicated on what foreign institutions do?
I think well, not just that. For foreign institutions are about 16% of the market. So not just them, this would also kind of change the view of domestic investors who are actually mostly loaded in mid and small caps. But that change will actually happen gradually. The delta between yesterday and today is the FIIs and the lack of trigger, which was lacking. So hence the immediate movement in terms of sentiment would come from FIs is the only limited point I am making. Net, what this does is it removes the macro negativity which was around the lack of deals coming through. Bear in mind that net, even over the last year, even with the US tariff, the impact was only about 30 to 50 basis points of GDP in terms of the actual numbers. It was more a sentiment impact, particularly in the context of globally, where a lack of a deal made us underperform global markets in a meaningful way. My sense is that underperformance versus global markets, which actually start to revise.
Interesting, because that impact on growth that a lot of people estimated at between 25 and 30 basis points now becomes a tailwind, doesn't it? You add that to your estimates for the new financial year. But having said that, Trideep, I don't want to get into your own strategy as a portfolio manager. What did it look like running up to today? And are you likely to change the texture or the breakup of some of the schemes? Maybe we can start talking about the diversified schemes first.
Indeed. So I think the first thing, we are bottom-up investors, quite frankly, and whenever we see valuation mispricing, which we were getting to in some sectors which were more export-oriented, like for instance, IT being one of them, chemicals being another, auto ancillaries, globally facing auto ancillaries in other. These three segments were gradually getting to more attractive valuations, and we were kind of anyway starting to nibble at them, given where they were available. What this does is this sort of an event fast forwards that sort of a transition, and that's where on fringes we have sort of acted upon to kind of make our portfolios more resilient in terms of the earlier sectors which were impacted more by the lack of such deals, and now all of a sudden the positive catalyst that this deals become.
Okay, let's talk about earnings as well, because Trideep, you've seen a part of the earnings season pan out in the third quarter, right? And some of those signs are that what you saw in the second quarter in terms of margin expansion, where a few companies were reporting better than expected performance on the bottom line, led by margin expansion and not by top line. Does that change in that, just to put things very simply for my viewer to also understand, companies were not selling more things. They were simply earning more for every unit that they sold. So do we see that pickup in demand take place as early as the current quarter, which is the fourth quarter, or do we have to wait till a better part of the new year is done?
Very interesting question. And there are two or three facets to this. Let me kind of take in parts. We've been saying for the last 2 or 3 months that the three themes of 2026 has been one, from trade deal to trade, from trade conflicts to deal making, which now with the two deals coming through has come through. The second point that we have been making over the last few months is that the earnings upgrade cycle over the last 12 to 15 months has been kind of moving downwards. And we have seen an earnings cut of about 12 to 15%, 12 to 13% over the last year or so, is finally turning or bottoming out. September quarter in that context was the first quarter where we saw 2 to 3% earnings upgrade coming through. This was mostly towards domestic-oriented companies, driven by partly a softer base and slightly better margins, which is what you were highlighting. I think post is deals coming through, while Q3 numbers are well struck and net we would see 1 to 2% earnings upgrades coming through. March quarter prospects get a little bolstered by, even to a certain extent, some of the export-oriented industries, where the outlook changes in terms of deal making. May not necessarily be in numbers, but they will start to see better order book situation, better visibility of trade, which will positively impact the multiples that they are trading at in the near term. and earnings over a period of next 6 to 9 months is what I would say.
Okay. I want to also get your view on the implications of the amount of issuance that is expected to take place in 2026 and whether that will be a mop for any additional liquidity that might be generated or interest that might be generated to deploy, and whether that will take away from the market. Because if money is being deployed into these new companies that are looking to raise funds, or old investors that are looking to sell on Dalal Street for the first time, then one would assume that it'll be difficult for the equity market as a whole to rise.
Yeah, it depends on the pipeline. The pipeline clearly has been negatively impacted in the last couple of months, given the macro negativity that has been kind of there. With the deals coming through, that I suppose that macro sentiment will improve, and so will the deals with IPO. But given that globally we've underperformed by close to about 40% over the last year, our valuations finally are reasonable, particularly on the large cap front as compared to 10-year average. I think the market has the appetite to take Indian paper. Of course, one has to distinguish between good paper and bad paper, and those selectivity investors will still have to kind of go through. But net, I think after a good close to 1.5 years, I see the sentiment towards India changing on the back of the Indo-EU deal and the US deal is the key headline that I wanted to kind of communicate.
Yeah,
and hence in that context, FII interest should be there in some of these trade days.
Okay, so that is well communicated. But Trideep, let me ask you this. Over the last couple of years, we've been stressing very importantly in a lot of conversations that you and I have had, and in conversations that I've had with a lot of other fund managers, which is keep your return expectations grounded. If I were to ask you that question, if I were to have asked you that question last week, if I'm asking you this question just now, has that answer changed just a tad bit on the upside? And,
yes.
And to what extent?
Well, to what extent? So ultimately, we are sort of, worshippers of earnings, if you may call it that way, as bottom-up investors. I think all this will translate into better earnings towards the back half of this year, not immediately. So immediately you will see in the PE multiples over a period of time, you will see earnings estimates coming through. I do see an earnings upgrades hypothesis being strengthened over the next 9 to 12 months by about 2 to 3% incrementally on the back of these transactions coming through. But what this will do is this macro negativity of news headlines impacting India will now shift back to earnings from an Indian market standpoint, which is genuinely good.
Okay. So, but we're still talking about long returns of plus or minus, plus of about plus 2 to 3 percentage points over nominal GDP. Is that fair?
That's the change in earnings estimate. Ultimately, what you will do is the markets will put a multiple to it, and hence the returns will be maybe higher than that. But certainly, kind of we do see a better earnings scenario over the next 12 to 15 months on the back of this.
Okay, very interesting. All right. So a lot of positives to take from that conversation. Trideep, thanks so much for taking the time, and I think it's a good time to be an investor in India, as it always has been. It's just reinforced by the kind of move that you've seen in the equity market today.
Thank you.